Lana, and now we are trying to measure money supply, the quantity of money supplied. So what is money? It is dirham. So what is the quantity of money supplied? So we need to understand this term. So the first definition of money supply is called M1. It's called M1, money one, M1, which is transactions money, or the narrow definition of money. What is M1, Lana?
M1, or transactions money, money that can be directly used for transactions.
Okay, so what is M1 or transactions money? Money included in M1 can be used directly, easily to make a transaction. So think about, you are going to Carrefour to buy something, and you can use these kinds of money to purchase a bottle of milk. This is transactions money. So money included in M1, money can be used directly for transactions. Lana.
M1 equals currency held outside banks plus demand deposits plus travelers' checks plus other checkable deposits.
Okay, so the most important two items included in M1, the first one, currency held outside banks. So currency, money, banknotes outside of the banking system. For example, at the moment, Salim holds 300 dirhams in his wallet. So how much I have right now? Only 300 dirhams in my wallet. Lana has 500 dirhams. Farhana has 2,000 dirhams. So money in our hand, money, banknotes in our pocket, outside of the banking system, plus demand deposits or current accounts. So I have a balance. I opened an account in First Abu Dhabi Bank. So my balance at the moment, 600,000 dirhams. So demand deposits, all current accounts by customers, companies, whatever. So current accounts or demand deposits at the commercial banks at this moment. So let's talk about a single guys, for example, Salim. So I have 300 dirhams in my wallet, plus 600,000 dirhams in my current account. So the bank gave me tools to use or to access 600,000 dirhams. So they gave me debit card, so I can go to Carrefour and pay not cash, pay by using the card. And also they gave me checkbook, so I can go to agency and buy a new car and pay the amount by check. So still I'm using my current account. So this kind of money can be directly used for transactions. There are other items such as traveler checks, other checkable deposits, also part of M1. But keep in your mind, so you can remember them, till the end of the chapter, I will use M1, which includes cash in our hand, plus demand deposits. So this is the definition, narrow definition of transaction money, or M1. Lana.
M1 is a stock measure. It's measured at the point in time. M1 at the end of December 2012 was $2,440 billion.
Okay, so M1 is a stock measure. It is not a flow measure. So it can be calculated at a point of time. So at this moment, Salim has 300 dirhams cash plus 600,000 dirhams in his current account in First Abu Dhabi Bank. This doesn't mean that each month or each year I will receive this amount of money. So it is a stock measure. So by next month or by next year, my money may increase or decrease. So we can calculate it again. Let's go to Farhane. Farhane.
Yes, doctor.
Now we will go to not narrow definition of money supply. We will go to broad money, which is M2, broad money, wider definition of money, which is called M2. But still, what is the important one is M1. But this is just for your knowledge. Farhane.
Broad money, near monies, close substitutes for transactions money, such as savings accounts and money market accounts.
Okay, so near monies, we translated into Arabic as أشباه النقود, something similar to money. So saving account and my account in financial market with the broker. So I can go to my bank and withdraw money under certain conditions from my saving account. And I can sell some of my shares and bonds and transfer the money to my current account, but it takes a little time. So it is not, I cannot use this money readily. I cannot use them when I go to Carrefour. So when I go to Carrefour, I can use cash or debit card, which is my current account. So this is a close definition of money. Farhane.
M2 or broad money, M1 plus savings accounts, money market accounts, and other near monies.
So what is M2? M2, as you see in the highlighted one, equals M1 plus saving account plus my account in financial market and other near monies close to them. Farhane.
I have to read the definition, just you explained, or beyond M2?
As you like.
No, yeah. you are explaining that.
Go ahead.
That
Go ahead.
I have to read it again.
Go ahead. Farhane. Go ahead. Read whatever.
M2 equal M1 plus savings accounts plus money markets accounts plus other near monies.
Go ahead.
M2 at the end of December 2012 was 10,402.4 billion. M2 is sometimes more stable than M1.
So M2 is much more than M1. So if you see M1 2.5, but M2 is 10, so it is much more than M1. And M2 is more stable, so it seems to be M1 is fluctuated. M1 refers to the liquidity in the market. M1 refers to the liquidity in the market. So sometimes we say we have lots of liquidity in the market, and that push prices to increase, and we will experience inflation. And sometimes we say there is a lack of liquidity. We don't have money in the market, so there is no pressure on the prices. Beyond M2, Farhana.
Beyond M2, one of the very broad definitions of money includes the amount of available credit on credit cards, your charge limit minus what you have charged but not paid as part of the money supply.
So we can add more items such as my credit cards. So my credit card with the arrangement with a commercial bank, it allows me to spend immediately extra 50,000 dirhams, but this will consider as getting a loan. But it's easy to use this kind of money. Farhana.
There are no rules for deciding what is and is not money. This poses problems for economists and those in charge of economic policy. However, for our purpose, money will always refer to transactions money or M1.
Okay, so don't get confused. What is the definition of money supply? We will use M1, which is transactions money. So M1 includes simply, let me simplify this definition so we can go further for analysis. M1 includes cash in our hand, cash outside of the banking system, plus demand deposits or current account. So it's for the whole country. So for example, Salim at this moment has 300 dirhams in his wallet, plus 600,000 dirhams in my current account. So now we will talk about the banking system. The banking system includes mostly commercial banks plus central bank, the central bank. So again, the banking system includes many commercial banks and one central bank. So what is the private banking system?
The private banking system, financial
intermediaries,
is banks and other institutions that act as a link between those who have money to lend and those who want to borrow money.
Okay, so financial intermediaries such as First Abu Dhabi Bank. So First Abu Dhabi Bank works as a link between lenders and borrowers. So I have extra money, I will keep it in the bank, and the bank will use this amount of money to borrow some others. So the bank is a link between those people who have extra money with other people who needs some money to do their needs. Raja.
The main types of financial intermediaries are a commercial bank, followed by saving and loan association, followed by saving and loan association, life insurance companies, and pension funds.
Okay, so the banking system is presented by mainly commercial banks. But in some countries, we have other institutions, such as saving, loan associations, life insurance and pension funds are part of the private banking system because they have lots of money, so they can affect the level of the liquidity because they put their hand on a huge amount of money and they work with money. So thank you, Raja. So now how banks create money? So commercial banks, I'm talking now about the commercial banks, such as First Abu Dhabi Bank or Sharjah Islamic Bank. These commercial banks can create money. Maybe for some of you, this seems to be strange, and they will ask, how do commercial bank create money? And some other feels that commercial banks cannot create money. Some others feel that only the central bank has the right to print banknotes, and it's true. The central bank has the right to print new banknotes, but still the title is true. Commercial banks can create money. So historical perspective, we will start with goldsmiths. What's the meaning of goldsmiths? Such as Damas. What's the meaning of goldsmiths?
الصايغ يمكن؟
Yes. What's your name?
لانا.
Again, what's your name?
لانا.
نعمة, right?
لانا.
Lana. Okay. So goldsmith in the designer of jewelry, and we can use it as the owner of jewelry shop. So this is goldsmiths. Let's go to Hamdan Abdullah. Even the story, yes, Farhana?
Doctor, I have to go somewhere. Can I leave? Can I go?
Yes, you can go. Goodbye.
Thank you, doctor.
Hamdan Abdullah. عالية حسن.
Yes, doctor.
عالية كيف حالك؟
الحمد لله doctor.
Yes, help me. The origins.
The origins of the modern banking system date back to the 15th and 16th centuries, when gold was used as money but was also inconvenient to carry around. People began to place their gold with goldsmiths for safekeeping. The receipts issued to the depositor became a form of paper money. The receipts were backed 100% by gold.
Okay, so what's the idea by spoken by Alia Hassan? So gold works as money. So this is commodity money. You can purchase something and pay by gold. So gold serves as commodity money. Later, people started to keep their money with the goldsmiths. So goldsmiths as a store, as a bank. So I'm going, because it's dangerous to hold much gold with you, especially in the 15th and 16th century. So I will deposit my gold with the goldsmiths. Let's say, let me call it Damas. So I have 60 grams of gold. I will give it to Damas, and Damas will issue for me a receipt of 60 grams of gold. At any time, I can go back. I can go back to the goldsmith and demand my gold. So the duty of the goldsmith is just to keep safely my gold. So the receipts were backed or supported 100% by gold, because at any time I can demand, I can claim by showing the receipt to the goldsmith. So now the receipts work as paper money, works as paper money. So see here, I think in the next paragraph, what we will say. So later, since the receipt is supported by gold, at any moment I can go back to the goldsmith and demand my gold. So when I go to purchase something, I can pay by giving them the receipt, and they feel the receipt is supported by gold. They can use the receipt and go to the goldsmith. So it's similar to using the check. So at the moment, if I need to buy something, I can pay by check, and the seller feels that the check is similar to the money because they can show the check to the bank and they can withdraw money. Okay, Alia.
Yes, doctor. The goldsmith found that people did not come often to withdraw gold. People simply exchanged their paper receipts, so the goldsmith found extra gold sitting around that they could lead out, effectively changing from depositories store to bank-like institution that had the power to create money without adding any more gold to the system. The goldsmith increased the amount of money in circulation.
Okay, so what's the idea here? Since people started to exchange receipts instead of gold, see, it's more safe to exchange receipts than actual gold. And now the goldsmith realized that he or she holds extra gold, and those people who deposit gold, they didn't come back to withdraw gold. They are satisfied with the receipts. So now he started to lend money at interest rate, definitely, by issuing new receipts without real gold. Because if so, I assume I'm the goldsmith, I'm going to lend Alia 10 grams of gold. I will give her a receipt of 10 grams of gold. Alia purchased something from Ahmed Muhammad and she paid the receipt. Ahmed Muhammad came back to me and asked me for gold. Already I have much gold with me, so I can pay. I can return 10 grams to Ahmed Muhammad. So now the goldsmith turns to be bank-like, something similar to a commercial bank. Thank you, Alia. Ahmed Muhammad. مريم عبد الله.
نعم دكتور.
كيف حالك مريم؟
الحمد لله دكتور تمام. كيف حالك؟
Read this for me.
Okay. Goldsmiths turned bankers did face quarantine problem once they started making loans. Their receipt outstanding claims on gold were greater than the amount of gold they had in their vaults at any given moment. In normal time, goldsmiths were safe, but once people started to doubt the safety of the goldsmiths, they would be foolish not to demand their gold back from the wallets.
Okay, so what's the meaning of wallet? The boxes to keep gold with the goldsmiths. So wallet, it is a safe box to store the gold. Okay, so now goldsmith works as a banker, and in normal days he's safe because normally people who deposits gold at his place, they didn't come back to withdraw gold. But once people started to doubt, so they will run to him to demand their real gold. So now he lent 10% of his gold because he issued, for example, 10% extra. So he has, let's say, 100 grams, but he issued receipts of 110. So he will be in trouble because he issued receipts, but at the moment he doesn't have such money. Thank you, Maryam Abdullah. Let's go to Munira Hassan. Munira. Reem Khamis.
Yes, doctor.
Are you Reem?
Yes.
Run on a bank.
Run on a bank occurs when money of those who have claims on a bank deposits present them at the same time.
Okay, so we use this term, run on a bank, when depositors go together or in close time and demand their deposits. So think about First Abu Dhabi Bank. If all depositors go to First Abu Dhabi Bank and ask to withdraw money, at the moment, the First Abu Dhabi Bank doesn't hold cash equals to total deposits because he already uses some of the deposits to give loans to others to earn benefits. Reem.
Today's bankers differ from goldsmiths. Today's banks are subject to a required receive ratio.
Okay, so according to the regulations set by the central bank, the commercial bank should keep a reserve ratio for their deposits. So, for example, assume First Abu Dhabi Bank or assume Salim deposited 100 dirhams at First Abu Dhabi Bank. If the reserve ratio 20%, so in this case, according to the regulations of the central bank, the commercial bank will keep in their boxes as reserve 20 dirhams, and he has the right to give loans to others of 80 dirhams. So at any moment, if the bank loaned up, if the bank gave maximum amount of loans they can, so they will give loans worth of 80 dirhams and keep reserve in their boxes worth of 20 dirhams. So assume the bank in a certain moment go to trouble. So he will seek help from the central bank, and the central bank is ready to support any commercial bank in trouble. Reem?
Goldsmiths had no legal reserve requirements, although the amount they loaned out was subject to the restrictions imposed on them by their fear of running out of gold.
Okay, so goldsmiths in the old days had no regulation regarding to reserve ratio. So just the fair, because they felt afraid they will be in trouble if depositors run on him to withdraw gold. So they try to issue new receipts or lend a limited amount of gold. But nowadays, with commercial banks, the matter is similar to the idea of goldsmiths, and we will see maybe by next meeting how commercial banks create money. Thank you, Reem. Let's go back to Lana.
Yes, doctor.
Read the whole story for me.
Okay. The modern banking system, a brief review of accounting. Assets minus liabilities equals net worth, or assets equals liabilities plus net worth.
Okay, so this equation is equation number one in accounting. Equation number one in accounting. So for any company, and the bank is a company, this is the balance sheet, shows that assets equals always liabilities plus net worth. So let's give a little explanation about this equation in accounting. Lana.
Assets are things a firm owns that are worth something. For a bank, these assets include the bank building, its furniture, its holdings of government securities, bonds, stocks, and so on. Most important among a bank's assets, for our purposes at least, are the loans it has made. Other bank assets include cash on hand, sometimes called vault cash, and deposits with the central bank.
Okay, so see here, what are the assets of First Abu Dhabi Bank? So let me select the important item, cash. Cash. This is called reserve. Part of the reserve in their wallet, or they deposited at the central bank. So for me, I will call it reserve. So what is reserve? Cash kept in the bank wallet, in their boxes, or they deposited at the central bank. But what is the second important item? Loans given to others. Loans given to others. We can add more items, but are less important, especially for our analysis, such as building, furniture, computers, and national bonds, or financial shares and stock. This is called government securities. But these items are less important, especially in the United Arab Emirates. So what are the assets? Cash or reserve plus loans, building, government securities, or national bonds. Lana.
Federal Reserve Bank, the Fed, the central bank of the United States. A firm's liabilities are its debts, what it owes. A bank's most important liabilities are its deposits. Deposits are debts owed to the depositors, because when you deposit money in your account, you are in a sense making a loan to the bank.
Okay, so liabilities. The most important liabilities is called demand deposits. So when Salim deposits 100 dirham at First Abu Dhabi Bank, as I lend the bank 100 dirham. So the bank owes me The bank has to return me. So the bank owns cash. The bank owes 100 dirham to Salim. So what are the important item in liabilities is called demand deposits or current account, in addition to net worth or equity, the amount financed by the owners or stakeholders of the. This is a simple, very simple balance sheet for a commercial bank. Assets equals all assets of 110 equals always liabilities. What are the important items in assets? Reserve, cash at their boxes, and deposits at the central bank, plus loans given to others. Liabilities include demand deposits, current accounts. So for example, Salim deposits 100 dirhams at First Abu Dhabi Bank, plus net worth or the equity or the capital financed by the owners or the stakeholders of the company. So both sides are equals. Raja, could you read this for me? Raja?
Yes, doctor.
Figure 10.
Okay. T account for a typical bank, millions of dollars. The balance sheet of bank must always balance so that the sum of assets, reserve, and loan equal the sum of liabilities, deposit, and net worth.
Okay, so this is balance sheet. The sum of assets equals liabilities. Assets include reserve and loans, while liabilities includes deposits and net worth. What is a reserve with Ali Hassan? Just a moment. أيوة حجية. أيوة. Okay, so what is so always assets equal liabilities. So what is reserves with Alia Hassan?
The deposits that a bank has at the Federal Reserve Bank plus its cash on hand.
Okay, so see here, what is reserves? Include two items. Cash in the bank wallet or in the bank boxes, plus the bank deposits some money at the central bank. So for me, reserves is close to cash. So if one of the depositors wants to withdraw money, I will use the reserve. So I can use the reserve to return the depositor's money. What is required reserve ratio with Alia?
The percentage of its total deposits that a bank must keep as reserves at the central bank.
Okay, so what is the required reserve ratio? Let's calculate it here. 20 divided by 100 times 100. So it is 20%. So assume the central bank asked commercial banks to keep 20% as required reserve ratio. So if the commercial bank got deposits of $100 million, they have to keep as a reserve $20 million. Why? Because the reserve ratio is 20%. So immediately you can read the reserve ratio from this slide. In next meeting, we will talk about how commercial banks create money with slide number 12.